Assalamu alaikum students. Today we will study capital budgeting. So here in this chapter we will learn some basic investment appraisal technique, basic investment evaluation technique. Right. So what we will have here in this chapter. So we will mainly study ROCE, that is return on capital employed, or it is otherwise called accounting rate of return method. So this method is commonly used by accountants normally. So then we will study payback period method, we will study net present value method, and also we will study internal rate of return method. So these are the four method of investment appraisal we will study in this chapter mainly. This is a very beginning course of finance, so here we will confine our discussion to only these four methods. Right. So let us solve one example to understand return on capital employed or accounting rate of return method. So for example, here the question we have here is a project involves an immediate purchase of an item of machine costing $110,000. So that means if you start a project, you will need to purchase a machine that cost $110,000. Right. So if you purchase that machine, it would generate annual cash flows of $24,400 for 5 years. So that means you will get $24,400 each year, and like that way 5 years. Right. So it will generate an annual cash flow. So it will generate an annual cash flow of $24,400. That means at the end of each year, you will get on an average $24,400, and like that way you will get up to 5 years. Right. So now the machine purchased would have a scrap value of $10,000 after 5 years or in 5 years, which means after 5 years, if you sell the machine, you will get a scrap value or salvage value of $10,000 after 5 years when the project will terminate. So after 5 years, if you terminate the project, you will get a salvage value or scrap value from the machine of up to, you will get the scrap value or salvage value of $10,000 from the machine. Now depreciation is on a straight line basis. So it said, the question is saying that depreciation will be done on a straight line basis. So which means what will be the depreciation? So depreciation will be, now here, so what will be the depreciation? Right. So initially you are purchasing the machine. Initially you have purchased the machine at the price of $110,000, and after 5 years the machine will have a scrap value of $10,000. So that means over the 5 years machine is losing $100,000 value. So over the 5 years the machine is losing $100,000 value. So we will divide it by 5, and that means every year we need to depreciate $20,000 value from the machine. Right. Now return on capital employed method. So the ratio return on capital employed, the formula for return on capital employed is, so in the numerator we will have average annual profit before interest and tax. PBIT means profit before interest and tax, or in otherwise we can call it operating profit. So average annual PBIT, profit before interest and tax. Right. Or we can call it, like, if there is no administrative expense or any other thing, we can call it operating profit, or we may just call it profit before interest and tax, or earning before interest and tax. So average annual profit before interest and tax multiplied by 100% divided by annual capital cost or average capital investment. Right. So which means you may use annual initial capital cost, or some people they use average capital investment also. Right. So here average annual profit before interest and tax is $24,400 is given in the question. And so this is the annual cash flow that we will get at the end of every year, and from that we need to deduct the depreciation value. So we need to deduct the depreciation value to get the average annual profit before interest and tax. So this means this is the cash flow that we are getting from the project, and from that we need to deduct. For example, depreciation is the only expense. If depreciation is the only expense, in that case, so we will deduct this one. So 24,400 minus 20,000. So this is the profit before interest and tax. We'll multiply it by 100 to get the percentage figure. And if you divide it by initial capital cost, which is 110,000, that means the price of the machine. So if you calculate, we'll see that this is 4%. So ROCE, or return on capital employed, is 4%. So that means we are getting 4% return from the initial capital invested, right? And then if you use, some people they use in this formula, some people they use average capital investment in the denominator. So how should we calculate average capital investment in that case? So average capital investment means, so at the beginning of the project, the initial investment amount is 110,000, and at the end of the project, we are getting a scrap value of $10,000. So that means the capital we have left with, so the capital we are left with is only $10,000. So at the beginning of the project, the capital is 110,000, and at the end of the project, the capital amount is only $10,000. That means that is the scrap value. So if you divide it by 2, we will get the average capital investment is $60,000. Right. So return on capital employed, we are calculating it again by using average capital investment in the denominator. So that means we are dividing now we are dividing the average annual profit before interest and tax. We are dividing profit before interest and tax by average capital investment now. So if we use average capital investment instead of initial capital cost, what we will have? So here average capital investment is $60,000. So if you divide it by 60,000, the answer will be 7.33%. Right. So there is some inconsistency here. Some accountants they prefer to use initial capital cost, and some accountants they prefer to use average capital investment. So some inconsistency is here. So here when you use initial capital cost, the return on capital employed is 4%, but when we use average capital investment, the return on capital employed is 7.33%. So which one should we use? Some company they use this formula, initial capital cost. They use initial capital cost in the denominator. Some company they use average capital investment. Right. So decision rule: if the expected return on capital employed for the investment is greater than the target or required or hurdle rate of return, then the project should be accepted. Which means, for example, if your required return is 2% and return on capital employed is 4%, that means if you get higher return on capital employed, so that means if you get higher ROCE than the required return or hurdle rate or target return, in that case we should accept the project. So that means if you get more than the required return, if the ROCE or return on capital employed is more than your required return, in that case you can accept the project. So this method is as I said before, this method is commonly used by accountants. So this method has some advantage and disadvantage. Let's see what are the advantages and disadvantages. Well, advantage is obviously it's very simple method, easy to calculate. It doesn't use time value of money, that's why it's very simple. So it links with other accounting measures. Well, so to calculate this one, you will need to calculate depreciation, you will need to calculate initial capital, you will need to calculate average capital investment and all those things. So some accounting measure is required here, right? Disadvantage is what? It ignores time value of money. It ignores time value of money. So it fails to take account of either the project life or the timing of cash flows. Well, the cash flows, as the question says that the cash flows every year, we are assuming that we will get on an average $24,400 cash flows from the project. But earlier cash flows are more important than the later cash flows. So time value of money should be considered. But this method failed to consider the time value of money, right? So this is the major disadvantage. It varies depending on accounting policies. So this method will give you different result based, so it depends on what accounting policy you use. So that means, as I said before, some inconsistency is there. So some people, some accountants, they may use initial capital cost in the denominator. Some accountants, they may use average capital investment in the denominator. So some inconsistency is there. It may ignore working capital also. Well, here in this method we may consider only the machinery's cost or the fixed assets. So working capital may not be considered here in this method. Right. So now let us move to the payback period method. Let us move to payback period method. So payback period method, from the name itself, it's very clear. From the name itself, it's very clear what this method is about. So that means the payback period is the time of a project. So is the time a project will take to pay back the money spent on it. That means that here in this method we want to know how much time it will take, for us to get the initial investment back from the business or from the project. So for example, if you invest 1 lakh taka or 100,000 taka in a project, so we want to know how long will it take for the project or for the business to return our initial investment. So this is the payback period method. Right. So payback period means initial investment divided by annual cash flow. So initial investment divided by annual cash flow. Right. So now decision rule. Only select projects which pay back within the specified time period. Only select projects which pay back within the specified time period, or choose between options on the basis of fastest payback. So that means if you have 4 or 5 projects in your hand, and if you use payback period method as your sole criteria or only criteria to evaluate the project, in that case you can choose the project with fastest payback. Or you may have some criteria that, okay, I need to get payback within 2 years or within 3 years. So based on that criteria also you may decide to evaluate the project. Right. So what are the, first of all, let us see what are the advantages and disadvantages of this method. Well, it is easily understood and easily calculated. So this method can be very easily calculated. In fact, this method is the most commonly used method. So it doesn't require any financial knowledge. Even the financial illiterate people also, those who do not have any financial literacy, they also use this method. For example, the tea stall, if you start a tea stall business, or if you start a grocery business, you may use this method if you do not have any financial knowledge. If you do not have any financial knowledge, you can easily use this method. As I said before, this method is the most commonly used method. For example, if a rickshaw puller, if he or she buy a rickshaw at the price of 20,000 taka, so before he or she buy that rickshaw puller wants to find out how long will it take for him to get the initial investment of 20,000 taka back. So that means before buying a rickshaw puller wants to find out how long will it take for him to get the 20,000 taka investment back. Similarly, if a person start a tea stall business, so if he needs to invest 50,000 taka to open a tea stall, in that case he or she want to find out that how long will it take to get the 50,000 taka back. That means how long will it take for him or her to get the initial investment back. That means how much time it will take by the business to generate enough cash flows to return the initial investment. So that means payback period. So that means it doesn't require any financial literacy. You know, any person or any people can calculate these one very easily. So it is useful for mainly equipment with rapidly changing technology. If, for example, if new plant is likely to be scrapped in a short period because of obsolescence, a quick payback is essential. So I can give you an example. For example, like technology based company. Suppose Apple company, they want to bring a new iPhone or new model in the market. So bringing a new model with advanced feature requires lots of investment as a researcher for research and development. So Apple company, before they bring a new product with new feature in the market, by investing a lot of money in the research and development, they want to know that how quickly they can get the investment back from the product, from that project, from that particular project, how quickly they can get the investment back, because they know that within 6 months or 1 year, that product, that new features or advanced features will be easily imitated or copied by their competitors. So as soon as the technology or new feature is copied by their competitor, they will be bound to reduce the price of the product. So that's why they want to know. And not only that, so that new feature will no longer be fresh in the market. So in the mobile market or technology market, always new technology come and previous model or previous products get obsolete very quickly. So because of that, technology based products, so technology based companies, they want to know that how quickly they can get the investment back quickly, so that how quickly they can get their initial investment on the project back, so that they are safe, right? So it favors quick return because rapid project payback leads to rapid company growth. Well, if you can get quick payback, obviously it will give you rapid growth. However, such policy may overlook many profitable investment opportunities because of slow payback period. This is one of the major disadvantages, because in the payback period method, we are only considering quick payback. If for example, a project may not necessarily give you quick payback, but it may give you very good cash flows for a longer period. So such projects, if you consider only payback period as your criteria of evaluation, so projects with longer period or projects with good cash flows, projects with longer period of cash flows will not be evaluated or may not be considered. So that means you may have some projects that will give you very good amount of cash flows for longer period. So these projects may not give you quick payback. Because of that, you may not consider those projects if you use only payback period criteria as for your evaluation. So rapid payback also minimizes risk. This is advantage. Rapid payback also minimizes risk because you don't know what may happen in future. So if you can get quick payback, it minimizes risk. Rapid payback maximizes liquidity. Obviously, if you can get very good amount of cash quickly, so it will improve your liquidity position. It uses cash flows, not accounting profit, so is likely to produce an optimistic figure. So these method do not focus on profit. These method focus on cash flows. So in finance, we mainly prefer to deal with cash flows rather accounting profit. So this method will consider cash flows, not accounting profit, because accounting profit is very subjective. For example, you made a sale, so you sold almost 100,000 taka amount of product monthly. So last month, for example, you sold almost 100,000 taka amount of product, but most of those sell made on credit. Because of that, that means you do not have sufficient amount of cash in your pocket, because most of the products you sold those products on credit. Because of that, you made the sell, and because of the, so for example, you make a, on an average you make 10% margin from the sell. So that means you made a sale of 100,000 taka last month, so you have calculated that you made a profit of 10,000 taka from those 100,000 taka sell, but most of the sale you made on credit, and because of that, although you have calculated that you made a profit of 10,000 taka, but that 10,000 taka is not materialized. So that means you do not have that profit in your pocket. So you do not have any sufficient cash flows to even continue the business. So this is very bad. So because of that, in finance we prefer to focus on cash flows rather than the profit, because profit is very subjective. Right, now the disadvantage. What are the disadvantages of payback period method? Well, as I said before, it ignores cash flows after the payback period. It ignores cash flows after the payback period. So in this method, we are only concerned about how quickly we can get our investment back. So whatever cash flow the business or the project is generating after the payback period, we are not concerned about that. So this is the major disadvantage of this project, of this method. It ignores the timing of cash flows. Well, as I said, it fails to consider time value of money. So time value of money is not considered, and because of that, as I said, this method can be easily used by anyone. So to evaluate a project using this method, you do not need financial literacy. So anyone or any people can easily calculate payback period. Right, it is subjective. Well, no definitive investment signal. Why it is subjective? Well, person to person may vary. You may decide to consider a project if it gives you payback within 2 years, but so that means for you the project may not be good, because the project is giving you payback after 3 years. So for you the project may not be very good, but for other people it may be very good project. So that means there is no definitive investment signal. It is very subjective. It's based on the person to person it may vary. So there is no objective measure as to what length of time should be set as the minimum payback period. So that means there is no fixed criteria that what length of time or how long should we consider to what should be the minimum payback period. That is not defined in this method. So that means the minimum payback period good to consider a project is not mentioned, it can vary from person to person. So minimum payback period that we should consider may vary from person to person. So that's why it is very subjective. So that's why investment decision is also very subjective. So these are the advantage and disadvantages of payback period method. Right, so before I go for the next things, let us solve a problem. So that we can get a clearer picture. Right, so now let us look at this question. So what we have in this question? So question is saying, what would be your decision about the following project if your required payback period is 3 years? So what would be your decision about the following project if your required payback period is 3 years? So now let us first answer this question before we learn and solve the remaining two questions. So first of all, we will solve the part A of this question. So that means we need to find out the payback period of the following project. So this is the data we have about the project. So here what we can see, at period 0 we need to make a negative cash flow. There is a negative cash flow. That means this is the initial investment we need to make. So at period 0 we need to make a we need to make an initial investment of 240,000 taka in the project or business. So after year 1, that means at the end of year 1 we may get, so after 1 year we may get 80,000 taka net cash flow from the project. So net cash flow means like there will be a lot of inflows and there will be a lot of outflows. So we need to get net inflow figure in this here. So that means suppose, so after 1 year, so at the end of year 1 we may get total 80,000 taka net cash flow from the project. So after year 2 we may get net cash flow of 120,000 taka. After year 3 we may get a net cash flow of 70,000 taka, and like that way we can get cash flow from the business up to 7 years. So 7 year is the, so here we have 7 years data. So that means we are considering that the business or the project will last up to 7 years. So that means up to 7 years we may get cash flow from the business, or we may run the business or project up to 7 years. So now we need to find out the payback period and provide decision that if our required payback period is 3 years, should we do the project? So always remember, this is only forecast, this is only prediction about the project. So that means we haven't started the project yet. So before we start the project we need to evaluate, we need to find out based on some forecast or based on our forecasted cash flow, we need to find out whether the project or the business will be investment worthy for us. So first of all we need to find out whether the project or business will give us the payback within 3 years. So now let us find it. So to find out the payback period, what we need to do, we need to calculate cumulative cash flows. So we need to calculate cumulative cash flow. So that means we need to add these two first. So that means we need to add these two first. So we will add these one and these one. So that means 80,000 minus 240,000. So how will we do it? So minus 240,000. So minus 240,000 plus 80,000 is equal to, so if we do it like that way, what we will get? So minus 24,000 plus 80,000. So we will get is minus 160,000 taka. So that means after, sorry, not here. So these will be in the period 1. So these will be in the period 1. So that means this is the cumulative cash flow. So for what we have done is we have added this one and this one. So that means minus 24,000 plus 80,000. So what we get 160,000. So that means after year 1, so minus 160,000. So that means after year 1 we still need 160,000 taka payback. After year 1 we only got 80,000 taka payback. We still need 160,000 taka more from the project to get the investment back, right? So now what we will do, we will add this one. So we will add this one with 120,000. So that means we will add this one plus this one. So if you add these one and these one, what we will get? So what we will get is minus 40,000. That means after year 2 we still need 40,000 taka to get our investment back, right? So now what we will do, we will add this one with 70,000 plus 70,000. So that means this one, we will add this one, and this is this cash flow. So minus 40,000 plus 70,000. So that means we now how much we need? So we do not need anything. So what we can see, we got the payback, because after second year, after year 2, we needed only 40,000 taka back for the payback. So after year 2, we needed only 40,000 taka from the project to get the payback. But in the third year, we are getting 70,000 taka cash flow. So in the third year, we will get 70,000 taka cash flow. So which means, so we will get our 40,000 taka cash for our payback and a 30,000 taka surplus from the project. So that means after year 3, we will be in a surplus. So we will get we will have our payback plus a surplus of 30,000 taka, plus a surplus of 30,000 taka. So after year 3, we will have our payback plus a surplus of 30,000 taka. So that means the payback period is what? Obviously, payback period is not 2 years. Payback period is not fully 3 years, because after year 3, we are in surplus of 30,000 taka. That means we got our payback of 240,000 taka, we got our payback of 240,000 taka and a surplus of 30,000 taka after year 3. So which means payback period is more than 2 years but less than 3 years. So now let us calculate the payback period. So payback period is 2 years plus, so more than 2 years but less than 3 years. So 2 years plus. So 2 years plus how much? How much more than 2 years? So that means 2 years, how many months more? So that's what we need to find out now. So as you can see, after year 2, after the second year, after year 2, we still need 40,000 taka more. But at the third year, in the third year, we got 70,000 taka cash flow. We don't need 70,000 taka for our payback. In the third year, we got 70,000 taka cash flow, but we don't need 70,000 taka for our payback. We only need 40,000 taka payback. We need only 40,000 taka payback. So how should we calculate it? So what we will do is, how should we do it? So payback period is what? We know, we already got that payback period is more than 2 years, because after year 2, we still need 40,000 taka more to get our payback. But after year 3, we are in surplus of 30,000 taka. We don't need a surplus. We just need our 240,000 taka initial investment back. So that means payback period is more than 2 years but less than 3 years. So now what we need to find out, 2 years and how many months. So as you can see, after year 2, we still need 40,000 taka. But in the third year, we are getting 70,000 taka cash flow. In the third year, we got 70,000 taka cash flow, but we don't need 70,000 taka. We only need 40,000 taka. So if we consider that over the 12 months of the third year, the cash flows, we received the cash flows consistently, or we received the cash flows at equal amount over the 12 months. So in that case, we just need to find out that how many months will it take for us to get 40,000 taka back. So after year 2, we just need 40,000 taka cash. So we need to find this 70,000 taka we got over the 12 months in the third year. This 70,000 taka we got over the 12 months in the third year. So we need only 40,000 taka. So 40,000 taka. So how many months will it take? So 70,000 taka we got over the 12 months. So we need to find out how long will it take, how many months will it take to get only 40,000 taka that we need. So 40,000 divided by 70,000 multiplied by 12. So in that case, what should be the answer? Let us calculate. So that means what we can see, payback period is more than 2 years but less than 3 years, and if you calculate it to get the exact how many months will it take after 2 years, what we can see, 40,000, that means 40 we need after 2 years we need 40,000 taka more, and in the third year over the 12 months we got 70,000 taka. So that means 70,000 taka we will get over the 12 months. So we just need 40,000 taka more. So that means 40,000 divided by 70,000 plus 12 months into 12 months. So if you calculate, we will see that payback period is 2 years 6.8571 months, right? So this is the payback period. Now the decision criteria, decision about the project. So it said that a question asked us to find out that what would be our decision about the project if required payback period is 3 years. So that means required payback period is 3 years. So that means, as we can see, the project is generated. So the decision. Now let us write the decision. So the project is generating earlier payback because we needed the payback within 3 years. We need the payback within 3 years. But as you can see, the project is giving us the payback before 3 years. The project is giving the payback before 3 years. So obviously requirement is fulfilled. So required payback period is fulfilled. So that means the project is generating enough cash flows to give earlier payback, then the required payback of 3 years, then the required payback of 3 years. So the project is generating enough cash flows to give earlier payback, then the required payback of 3 years. So therefore we should accept the project. So we should accept the project based on payback period criteria. So we should accept the project. So we should accept the project based on payback period criteria. Payback period criteria. So we should accept the project based on payback period criteria. So that's how we can answer part 1, right? Now let us solve the second part of the question. So here in the second part of the question is asking us to find out the discounted payback period. Always remember, whenever you see the word discounted or discount, that means you need to calculate present value. So whenever you see the term discount or discounted, so that means you need to calculate present value. So the question is asking, find out the discounted payback period, which means here in this method we need to find out the present values of all cash flows. So that means here as I said before, whenever you see the term discount or discounted, which means you need to calculate present values. So that means in this method we need to calculate, in this discounted payback period method, we need to calculate present value of all cash flows. So that means here in this method we need to apply time value of money. So question is asking, find out the discounted payback period if your required return or hurdle rate, or some people may call it discount rate, from the project is 15%. So that means if you need 15% return from the project, if you need 15% return from the project, that means this is the target return or the hurdle rate. So if your target return or hurdle rate or required return is 15%, then find out the discounted payback period and provide decision if you need discounted payback within 4 years. So that means if you need discounted payback if you need 15% return from the project, if you need 15% return from the project, and if you need discounted payback within 4 years, what will be your decision about the project in that case? Okay, so obviously to find out the discounted payback period, we need to calculate present values of all these cash flows. So let's do it. So that means we need to calculate the present value of all the cash flows. So these are the cash flows we have from the project, and we need to calculate the present values of all those cash flows, right? So as we already know, these are all individual cash flows. So we can see there is no similarity between the cash flows. All these cash flows are different. So what we can apply, so to calculate the present values of all these cash flows, we can use this formula, right? These are all single cash flows. These are all single cash flows. So to calculate the present values of all these future cash flows, we can use this formula. So first of all, this one is already in the present. As you can see, this one is already in the present. This one is this one is already in the present. This cash flow is already in the present. So this is already in the present, so we can stay, it will stay as it is. Now we need to calculate the present value of this one. We need to calculate, this is the cash flow. This is the cash flow that we will get after year 1. This is the cash flow we will get after year 1. We need to bring this cash flow at period 0. So that means we need to go 1 period behind. So this is the cash flow that we will get after year 1. We need to bring this cash flow at period 0. That means today. That means at present. So that means we just need to move 1 period behind, right? So how we do this, right? So what we need to do, we need to calculate present value of this cash flow. So as you can see, this is the cash flow that we will get after year 1. We need to find out the present value. That means the equivalent amount of this one at period 0. So that means we need to move 1 period behind. So power should be -1 here. So this is the future cash flow. So F is equal to this one multiplied by 1 plus R. R is the required return. So required return from the project is 15%. This is the required return or hurdle rate. So R is equal to 15%, that is 0.15. Power T is equal to, since we are moving 1 period behind, power should be -1. So if you calculate this one, this is the present value. So this is the present value. In the exam, you need to just show me the calculation for the first cash flow. That means you just need to show me the present value of the first cash flow. But you can just calculate and put the answer for the, you can just calculate the present values of the remaining cash flows and put the answer there. You don't need to write the formula or show me the calculation. But I am showing you the calculation. So here these will be 120,000. So 120,000, and these will be power -2. Now let's see what will be the answer of this one. Let's see what should be the answer of this one. So let's see what should be the answer of this one. So after we calculate present value of this one, what we can see, this is the cash flow that we will get. This is the cash flow. So this is the cash flow we will get after year 2. So we need to find out the present value of this one. That means we need to find out the equivalent amount of this one at period 0. So that means we need to move 2 periods behind. So that's why power should be -2. So that's why power should be -2, right? And obviously this is the future value. And obviously this is the future value. And if you calculate this one, so present value is this one. So similarly, you should find out the present values of all the remaining cash flows. Right, so these are all the present values. As you can see here, so when the cash flows is 80,000, future value is also 80,000. And since this is the cash flow that we will get at period 1, and we want to move one period behind to find out the present value. Power is -1, here power is -2, here power is -3, here power is -4. This is the cash flow that we will get at period after period 5 or after year 5. That's why power is -5 here, here minus power is -6, here power is -7, and like that way if you calculate present values, these are all the present values, right? So to find out the discounted payback period, always remember, if you want to find out the payback period, you need to calculate so when we want to find out the payback period, so we calculate it cumulative cash flows. So now we want to find out the discounted payback period. So when we calculated payback period, we used these one cumulative cash flows. So now we want to find out the discounted payback period. So similarly, we need to calculate cumulative. So since we want to find out discounted payback period, as I said before, discounted means we need to find out the present values. So we need to use cumulative present values. To find out the discounted payback period, we need to use cumulative present values. So now let us calculate cumulative present values. So first of all, so what do you need to do? So this is the first cash flow. This is the first present value. So first present value is -240,000. And then with these one, we need to add these one. So that means 69,565.2174. So that means these one plus these one. So we will add all the present values like that way. To find out the cumulative present values. So let us see what is the answer. So what we can see, so we added these one, so the -24,000, so -24,000 plus the second present. First, this is the next present value. So this is the present value at period 0. This is the present value. So this is the next present value. So that means when we add these one and these one, so like that way you need to add all the present values. So if you add these one and these one, we will get these one. And then what we need to do, we need to add these one with this one, 737.24 taka. So that means now we need to add these one and these one. So that means when we add these one with these one, we are actually, what we are doing, we are adding all these three present values. So if you add these one and these one, so that means in that case what you are doing, you are actually adding all these three present values. Because this is the value that we get. This is the value that we get by adding these first two present values. And if you add the third present value, in that case the answer that we will get, that will represent all these three present values. So let us calculate this one. So when we have calculated this one, we typed it like that way. So when we have calculated this one, we have typed it like that way, right? So -240,000 plus 69,565.2174, and then when you will add these one with these one, what you just need to do, you will just press plus. So you will just press plus along with these one. So plus and the next one. So next one is 90,737.24. So like that way we will add all the cash flows like that way. So when we add the third present value, like that way, 90,737.24, 90,737.24, like that way. So the answer is what? Minus 79,697. So the answer is minus 79,697. So minus 79,000 697.5426. So now what we will do, we will add the next present value with this one. So we will add the next present value with this one. So the next present value is 46,026.1362. This is the next present value. So what you need to do, we will just press, so we will just press plus after this one. So we will just press plus after this one, and then 46,026.1362. So 46,026.1362. So we will just add the next one with this one. So if you add the next one like this way, so the answer is, you can see, minus 33,671. So minus 33,000, so minus 33,671.4064. So with these one we will add the next one. So with these one we will add the next one. So with these one we will add the next one. Next one is 22,870.1298. So if we add the next one, so if we add the next one is plus 22,870.1298. So 22,870.1298. So if we add the next one with previous all those, so what we can see, we can get is minus 10,801. So minus 10,801.2766. So now we need to add these one with the next present value, with the next present value. So the next present value we have is 9,943. 9,943.5347. So 9,943.5347. So if you add these one, what we will get? So what we will do, we will press plus after this one, and then 9,943.5347. So 9,943.5347. So if you add it like that way, so what is the answer? Minus 857. So minus 857.7419. 7419. So minus 857.7419. So now let us add the next present value. Now let us add the next present value. So if we add the next present value, what we will get? 6,484. 6,484.9139. So now if you add these one, what should we get? So plus, and then 6,484.9139. So 6,484.9139. So if we add it like that way, so what is the answer? 5,627. So 5,627, 627.172. 172. So 5,627.172. So that means here this has become plus now. So that means we got the payback. We get a surplus over the payback. So we got a surplus over the discounted payback, right? So but we still need to write the next line also to find out the NPV. I will explain NPV later. So now we need to add the last present value. So the last present value we have is 4,511.32 2,444, right? So now if we add these one, so that means we just need to press plus. You just need to press plus, and then 4,511. So 4,511.2444. So 4,511.2444. So the answer is 10,138.4164. Right. Remember, this is the NPV. This is the NPV. I will explain why this one is NPV in the later part of today's class. Right. So for the time being, so just consider this one as NPV. I will explain what is NPV in the later part of the today's class. Right. So right, so as you can see here, we can see what we can see here is after year 5, so after year 5 we are still 857 taka short to get the discounted payback. So this is the discounted payback. So that means after year 5 we are still 857 taka short to get the discounted payback. But after year 6 we are in surplus over the discounted payback. So after year 6 we are in a surplus of 5,627 taka over the discounted payback. So remember, discounted payback means discounted, as I will repeat it again. Discounted means we need to calculate present value, and to find out the payback we need cumulative. So that means to find out the discounted payback we need cumulative present values. So we have already calculated present values, so we just need to calculate cumulative present values like that way. So after we have calculated cumulative present values, what we can see that after year 5 we are in short of 800. This is minus 857. So that means we are in short of 857 taka to get the discounted payback. But after year 6 we are in a surplus of 5,627. We don't need the surplus. We just need 857 taka present value. We just need 857 taka present value more to get the discounted payback. So what do you need to do? To find out the discounted payback? So what we need to do? So we need to find out the discounted payback. So to find out the discounted payback period, we need to, what do we need to do? Obviously we can see what discounted payback period is more than 5 years but less than 6 years, because after 5 year we are still in short of 857 taka present value. But after, right, so here as you can see, so after fifth period we are still in need of 857 taka present value. So that means discounted value. So this means after fifth year we are still in need of 857 taka discounted value or present value to get the discounted payback. So now in the sixth year over the 12 months period, if we get the cash flows consistently over the 12 months, and in that case, so this is the present value that we, or the discounted value that we get over the 12 months period in the sixth year. So we don't need this much amount of discounted value or the present value. We are in short of only 857 taka discounted value. So we just need 857 taka discounted value from this one. So that means this is the one that we will get over the 12 months period. So we just need to find out how many months more it will take for us to get 857 taka discounted value to get the discounted payback, right? So the discounted payback period is, obviously the discounted payback period is more than 5 years, because within 5 years, so after 5 years we are in short of 857 taka, right? So discounted payback period is more than 5 years, right? So now we want to find out how many months more it will take for us to get the discounted payback. So as I said, after 5th year we are in short of 857 taka discounted value or present value, and over the 12 months period in the 6th year we get 6,484 taka discounted value, right? So that means if you divide it by 6,484 taka and if you multiply it by 12, we will get exactly how many months it will take for us to get the discounted payback. So that means we will need, the discounted payback period is, we will need 5 years 1.5872 months to get the discounted payback. So this is the discounted payback period, right? Now the decision, well, so if you can see here, the question said that find out the discounted payback period if your required return or hurdle rate from the project is 15%. Obviously we have calculated the discounted values or the present values using 15% hurdle rate, and now it's asking that provide decision if you need discounted payback period within 4 years. So that means required discounted payback period criteria is we need the discounted payback within 4 years. But as you can see, discounted payback we got is 5 years 1.5872 months. So it's more than 4 years. So that means we are not getting the discounted payback within 4 years. So we are not getting the discounted payback within 4 years. So that means project failed to fulfill our discounted payback period criteria. So that means the decision will be, it appears that the project may fail to fulfill the required discounted payback period criteria based on our current projected cash flows. Well, based on our current projected cash flows, this is our current projected cash flows, this is our current projected cash flows. So based on our current projected cash flows, it appears that the project may fail to fulfill the required discounted payback period criteria, because we need the discounted payback within 4 years, but it takes 5 years 1.5872 months. So that means it's taking more time to get the to give us the discounted payback. So that means the project may be rejected, or we may, so that means at present scenario we should reject the project because it's not fulfilling our payback period, discounted payback period criteria. Or what we can do, we may revise our cash flow forecast. So that means if you can revise your cash flow forecast, in that case, or you may revise your discounted payback period criteria. That means instead of asking the discounted payback period within 4 years, if you ask the discounted payback period within 6th year or within 5.5 year, in that case you may be able to accept the project. But at present scenario, at current projected cash flow, or at current payback period, discounted payback period criteria, we are not able to accept the project. So this is the decision for the discounted payback period criteria. So now we will study net present value. Right. So now part C, find net present value, right? Find net present value. So now let us study what is net present value. So now let us study what is net present value. Net present value, or in short we call it NPV. This is the most widely used method for project evaluation. This is the most widely used method for project evaluation. So net present value means what? Present values or total present values of all future cash flows. So total present values of all future cash flows minus initial investment. This is the net present value. So the total present values of all future cash flows. So total present values of all future cash flows minus initial investment. So which means what? We need to calculate present values of all these cash flows. We need to calculate present values to find out the net present value. To find out the net present value, we need to calculate present values of all these future cash flows. And we have already done that. We have already calculated present values of all these cash flows here. And then we need to add all these cash flows, add all these present values. So total present values of all future cash flows. So that means we first need to find out the present values of all these cash flows. Then we need to add all these present values and deduct initial investment. This is the initial investment. We need to deduct this one. So as you can see, we have already done that in the table. Here, first we added what we have done. First we have added this one and deducted this one. So that means we have from this one we have deducted this one, and then we got this one, and then after that we have added this one. We have added this one, and after that we have added this one. So actually what we have done is, here in this column we have added all these present values. As you can see, we have added all these present values and deducted minus 24,000 and deducted this 24,000. So here what we have done is we have added all these present values. That means we have added all these present values. We have added all these present values, and then we have already deducted minus 20. We have already deducted 240,000. So that means this is the answer that we have got. So this is the NPV, net present value, right? So this is the net present value. So net present value we have already calculated it. We have already calculated it. So net present value is this one. We have already calculated it. So the net present value is this one, right? So net present value is this one. So we need to now interpret this one. We need to interpret this one. So what is our interpretation? So that means the project will generate enough cash flows not only to fulfill the required return of 15%. We needed 15% return from the project. The project will generate enough cash flows not only to fulfill the required return of 15%, but also provide a surplus of 10,138.4164 taka. So that means the project will give us not only 15% return per year, but will also provide a surplus of these 10,138 taka. So we needed 15. Our requirement was we needed 15% return from the project. Our requirement was this was the hurdle rate or required return from the project. So we needed 15% return or 15% return from the project. This is the hurdle rate, or we needed 15% return from the project. So what we can see, so this one means this one is positive, this one is positive, which means the project will give us not only 15% return, but also a surplus of, provide we don't need, but also a surplus of 10,138 taka. So that means project will give us not only the required return of 15%, but also a surplus of 10,138 taka. Right. So this is the interpretation. So obviously this is good project based on NPV. So based on the outcome of NPV, so it appears that the project is good. It appears that the project is good. So we can accept the project. So we can accept the project. Because it is already fulfilling our required return. So the project is fulfilling our required return of 15%. We needed 15% return from the project, and project is giving us 15% return. Not only 15% return, but also a surplus of 10,138 taka. So because our requirement is fulfilled, we can accept the project. So this is the interpretation. So in the exam, you need to write interpretation very nicely, but on your own language. Right. So here in this the example that we have solved, here NPV was positive and also 10,138 taka. But what if NPV is 0? So NPV 0 means, for example, NPV, if we get NPV at for example, NPV at 15% hurdle rate. If you get NPV at 15% hurdle rate, NPV at 15% hurdle rate, if you get NPV at 15% hurdle rate 0. If you get 0 NPV at 15% hurdle rate, what it means? So NPV 0 means what? So NPV 0 means what? You will only get your required return, no surplus. So this one indicates that project will give only required return of project will only fulfill. So project will only fulfill required return of 15%, but no surplus. So that means NPV 0 means what? Project will only fulfill required return. So here required return is 15%. So that means project will only give us 15% return, but no surplus. But if NPV is negative, if NPV is, for example, minus, for example, NPV is minus 5,000, what it means? So for example, if we calculate NPV at 15% hurdle rate like before, and if you get minus 15,000, if you get NPV minus 15,000, what it indicates? So project will fail to fulfill, project will fail to fulfill. Obviously negative means we are in short. Negative means we are in short. The project will fail to fulfill the required return. of 15%. 15% is the hurdle rate here. So if you calculate NPV at 15% hurdle rate, and if you get negative 5,000 like that, so you can say that the project will fail to fulfill the required return of 15%, and it is 5,000 taka short from achieving it. So that means we are in short of 5,000 taka to achieve 15% return. So negative means what? We are in short of this 5,000 taka to achieve 15% required return. So obviously that means project failed to fulfill our required return. So obviously project should be rejected. So the project, since the project failed to fulfill our return, since the project failed to fulfill our required return, we may reject the project. We may reject the project, or we may not accept the project. Or we may just reject the project. So if it is like if we get negative, if you get negative NPV, in that case, you may reject the project. But if you get 0 or more, so that means decision criteria is what? So the decision criteria for NPV. So decision criteria for NPV is what? NPV should be greater than equal to 0. So NPV should be greater than equal to 0. So NPV should be greater than equal to 0. That means it has to be positive. That means NPV should be positive. NPV should be positive to accept the project. So NPV should be positive to accept the project. Now let us study advantage and disadvantage of NPV. Right. So advantage of NPV. It considers time value of money. So that means you can easily find out that whether the project is fulfilling your required return, or if the project is giving you any surplus amount or not. So that means here you are considering time value of money. So that means here you are not considering all cash flows equally. So earlier cash, you are giving more importance to the earlier cash flows than the distant cash flows. So the more earlier cash flows are getting more importance than the distant cash flows. So that means time value of money is considered here. So this is the one of the major advantage of NPV method, net present value method. So that means present value takes account of the impact of interest, inflation, and risk over time. So obviously when you will determine your required rate of return, you will need to take account of inflation rate, you need to take account of the cost of capital, you need to take account of the risk associated with the investment and all those things. So based on all those things, you need to figure out what should be your required return from the investment. So and then you can easily, from NPV you can easily find out whether the project is fulfilling your required rate of return or not. Well, it is an absolute measure of return. As you can see, NPV is giving you that whether the project is not only fulfilling your return but also giving you any surplus amount or not. So it is an absolute measure of return. Right. So this method is based on cash flows, not profit. As I said before, in finance we prefer to deal with cash flows than profit, right? So cash flows are required to run the business. Profit is very subjective. So that means this method is based on cash flows, not profit. It considers whole life of the project, another major advantage. As I said before, in the payback period method, the limitation is we just consider how soon or how quickly we get the payback. But after the payback period, whatever cash flows we will get from the project, we are ignoring those cash flows in the payback period method. In the payback period method, we are only interested about the quicker payback. So after the payback period, whatever cash flow that we are getting from the project, we are not considering those cash flows. But in the NPV method, in the net present value method, we consider all the cash flows from the project. So that means we consider whole life of the project. This is the major disadvantage of net present value method. Now let us focus on the disadvantages. This method is difficult to explain to managers, particularly those managers who do not have any financial literacy. So if the manager have no financial literacy, or if the manager doesn't know what is NPV, what is present value, discount rate, required return and all those things, so it may sound little difficult for them to understand. So if the manager have no financial background or no financial knowledge, do not know time bill of money, in that case this method might be difficult for you to explain to them. Right. So to understand the meaning of the net present value calculated requires an understanding of discounting, that is requires an understanding of present value. So this method is not an intuitive technique such as payback period method. Well, this method is not like readily calculated method. So you cannot just easily calculate this method. You need financial knowledge to calculate this method. So it requires knowledge of the cost of capital. As I said before, so to figure out how much return you need to look for from the project, you should know the cost of capital. So capital can be again debt capital, equity capital. So that means cost of debt you need to know, cost of equity you need to know. We will study these things in our cost of capital chapter. So that means to find out that to calculate NPV, you need to figure out the rate of return first. How much rate of return you should look for from the project. So for that you need to know the cost of capital of the cost of capital. So obviously again this will require some financial knowledge. It is relatively complex. Well, we know that. Right. So that will be all for this lecture. So in our next lecture we will study internal rate of return method. Then we will study modified internal rate of return method. We will study capital rationing using profitability index, and we will also study the difference between accounting profits and cash flows and relevant costs. So what are the cash flows and relevant costs that we should consider in project evaluation and all those things. So in the next class we will study those things. So this is the end of capital budgeting lecture series